All right, friends, it's Wednesday. Now we are at midweek, and last night we just saw the markets turn red ahead of the Jackson Hole Symposium, a very big central economy policy event that is happening this week. So, what is next, right? So, after weeks of strong rally fueled by Q2 earnings from companies, now the attention has shifted back to the macro trends, to the Federal Reserve. And with inflation still sticky and rate cuts expectations, investors are bracing for what Powell will say this week. So let's break it down. Now, before that, if you haven't done so, I will appreciate it if you can hit the like and subscribe. It will really help me to keep making these videos for you. So let's look at what the S&P 500 earnings reported has shown us so far. So this was shown as of last week, right? That you can see that out of all of these earnings, right, there were 83% of the companies that actually beat their earnings, and out of that, right, out of these 89% of the companies that have reported, there was 7% that actually surprised. So you can see how it was a very, very strong Q2 earnings, right? Even though we had tariffs at the start of the quarter, but most of the companies there, they actually beat their earnings, and that was what actually led to the rally over the whole month of June and July basically. Now, so but with these earnings seasons ending now, this is where eyes are now back on the macro, right? About the Fed's policy. So this is just last night, right, where we saw that the S&P, the Nasdaq, and basically the whole market were actually red after briefly touching the all-time high. And what you can see, this is a technical overbought oversold indicator, right? So this gives us an idea as on different parts of the whole S&P out of these 25 years, right? And which areas is it overbought and oversold? And as you can see, we are right now at this territory. This is like the overbought territory. So, but does this mean, oh, it's time to sell our stocks? No. Okay, let's not jump to conclusion. There's a few data points that we want to look at. So you can see this is where we are right now. In fact, it will have been that way since you can see since 2024, right? But generally, the long-term trend is still uptrend, just that there are always regions of overbought and oversold conditions. So let's look at other data. Now you can see that this was a data done by Carson Research that historically, right, the S&P index average monthly returns from 1950 to 2024. So this is a data of 74 years record, right? What you can see is that the month of August and September, not just August, the whole of September as well, are generally known as weaker months as compared to the rest of the year, right? So weak August and September, and then a very, very strong October, November. Again, that is where companies start to report their earnings once again. So you have that double lever again, and the number is kind of mellow. But you can see where most of the historical data shows that August and September historically is a bit more volatile, where the market is will give negative returns for these 2 months. Now, then this concept I wanted to share with you is called what we call the RSI divergence. So RSI stands for Relative Strength Index. So like earlier what you saw, the overbought and oversold conditions, right? One of the ways to look at it is through this thing called the Relative Strength Index. So there's two kinds of divergence, right? So this is kind of looking at the price and the RSI together. So we have the bearish divergence and the bullish divergence. Now, I would just want to direct your attention to this regular divergence. The hidden divergence is another kind, but let's look at the regular divergence first. So the idea is this: as price continues to go up, but this RSI is like buying momentum, right? Because at the top is where it is oversold. So overbought, sorry. So if the price is going up, but the buying momentum is slowing down, so this is a bit of a bearish divergence, right? But to show you what this is theory, but to show you exactly what we mean, right? So let me show you the S&P chart. So you can see that there are different areas over here. Let me circle it. I've already drafted it out, right? So you can look at this period, right? Back in 2023, you can see this is the daily S&P chart from 2023 until April 2024, right? What do we have here? You can see that price were actually going up this whole period over here, but the RSI was going down, right? That means it is like basically the momentum is slowing down, buying momentum is slowing down. And what came after that, right? After the RSI slowed down, what you saw was actually the market dip. right? A general market dip, right? Even though, yes, of course, if you bought at this point, right, even the market dip, you'll still be up, of course, right? So this is the idea, the concept of long-term investing. But we're looking at this short-term macro trends for you to understand better of how to position your portfolio. So this is the first one. Now you can see that there's another period, right, which is from 2024 until February 2025, which is just this year. You can see that there's a little bit of uptrend over here, just slightly, not as much as earlier, a little bit of uptrend, but the same period, right, the RSI was also dropping. And what came after that, you can see that it was a drop, right? And this is also coupled together with Trump's tariffs. Now let's zoom in back to, let's look at what's happening now this time. So you can see a little bit of similarity is happening right now, similar things. What do you notice, right? Okay, you notice that over here, okay, let me change the brush. You notice that right over this period, okay, we are getting the same kind of uptrends right now. Okay, but what is looking at the RSI is also at a downtrend. So you can see this is a bearish divergence that we are seeing now. And what comes after that? I mean, this is very hard to say. No one can tell the future, right? But based on history, you can see that whenever we have a divergence, there will be some sort of correction, even though it might not be, it might not go back to where it was. That means, what I mean by that, if you are thinking the correction will go all the way back to like maybe the Trump time, you can forget about it, right? But I think that we'll probably expect a little bit of pullback towards downwards as well. As to where, is anyone's guess, right? It depends on what Powell says and things like that. So you can see that right now the chart is forming a little bit of bearish divergence, as you can see right over here. Now, so now all eyes are on Powell, right? This is what's actually happening this week, okay? Because now earnings have all finished. Eyes are now on him on what he's going to do with regarding the economic data that we've seen. Okay, but by the way, if you don't know already, I have a Telegram channel that is filled with personal market insights, real-time macro trends updates, and also investing knowledge that I learned over the years that I think will bring a lot of value to you, plus the occasional video of me rambling about life. And it's all free to join, okay? So if this sounds like your cup of tea, I love to have you to join me, right? Feel free to pause this video and scan the QR code, or you can join directly from the link in the description down below. So let's look at what the Federal Reserve aims to achieve. So you can see that this was a press release done in May 7, right? Federal Reserve issues the FOMC statement. So you can see that what they aim to do, right, at the end of the day, let me change my pen. What they aim to do at the end of the day, right, is to achieve maximum employment and inflation rate of 2.2% over the long run. So this is their goal. You can see they repeat it again. It's strongly committed to supporting maximum employment and returning inflation to its 2% objective. So what do they mean by inflation? When Fed says inflation, they're basically taking this proxy of the consumer price index of how much prices are increasing over the every single month. So you can see that the latest CPI is still elevated, right? It's at 3.1% for core CPI and 2.7%. So what the Federal Reserve say is they want to see this at 2%. Right, you can see that since 2022 they have been trying to bring it down, and it's actually been coming down, but they still want to kind of maintain it at 2%, and at the same time to have maximum employment. They want as many people as employed as possible. So this was the first thing that they look at. Another one is actually the producer price index. So producer price index is what comes before the consumer, what the suppliers are paying. So the idea is that if suppliers are paying an increased rate, the cost will then be passed on to the consumer. So the fact that this PPI was stronger than expected and CPI has been relatively soft suggests that now businesses are still eating much of the tariff cost instead of passing them on to the consumers. So then the idea is that may business start to reverse costs and start passing this cost to consumer. Because if they don't do that, it eats into their profits, right? They will have to they have reduced profit margin, they will have lesser money, and they might have to let go of some stuff. So the idea is that they will always push this cost to the consumer, basically people like me and you. So this spike, right, this spike that we see, you can see a spike, right? It actually shows that inflation is still around, right? It's coursing through, even though it hasn't been felt by consumers yet. Now, about the jobs on maximum unemployment, so you can see that job creations were down, right? It was actually very low, and then they adjusted the May and June one significantly downwards, right? Which actually caused Trump to actually fire the labor statistics, the lead, right? So you can see that this is not what the Fed wants, because employment is not very strong. Jobs creation is very, very weak. Okay, there's no new jobs that are appearing. So that is a bit of a thing that the Fed looks at, and a little bit of the concern that the tightrope they have to walk. And you can see unemployment rate. So we haven't seen this report. This is up to July, right? Unemployment of July is still 4.2. It has always been 4.2. But what basically the Fed wants is they want reduced unemployment rate, right? That is what they mean by maximum unemployment. And you can see that this is the PPI that we saw earlier. This is the one that you saw that the monthly change was actually one of the highest actually since 2022. So this was what kind of spooked the market a little bit. And because of all this refresh data that came out, right? Actually, last week from the video that I shared, you can see that actually the percentage of rate cut was 95%, 94, 95%, let's round up, right? That was last week, right? And 1 week later, after we seen the PPI appear, right? The data appear, right? You can see that now the rate cut has dropped from 94% to 84%, or roughly 85%. So you can see how the market expectation has shifted, right? That by 10%, even though it's still very, very high, but you can see how people are kind of like a little bit kind of like changing their view a little bit. So basically, there's rising unemployment, slowing growth, and mild inflation. So what people are betting on is that the Federal Reserve will actually move to prevent a hard landing. Okay, so when markets have lower confidence in cuts, it basically means higher volatility. So that is probably one of the reasons why people the percentage, the target rate probability of it cutting, right, has actually reduced. That's why you can see a little bit of volatility. Now, so what is everyone looking forward to this week? It is actually this thing called the Jackson Hole Economic Symposium. So this is a central banking conference held in Jackson Hole, Wyoming. So the Fed chair often sets the tone for global monetary policy here. Jerome Powell is going to speak, if I'm not wrong, on Thursday, on Singapore time, Thursday night, right? So and he's going to be accompanied with a lot of big people. Even the European Central Bank president will also be there. Now, if we look at history, right, how has Jackson Hole, how has the stock market performed around Jackson Hole? You can see, generally speaking, throughout almost every year, right, Jackson Hole has been the event at Jackson Hole has been, the overall the week before and after, right, the stock market actually gained. Except for 2022, one big period. So what main thing that the Federal Reserve said there is that he said that he warned of slower growth as the Fed actually was fighting high inflation. So that actually spooked the whole market. And then back in 2022, when the rate cuts were actually when the Federal Reserve were actually increasing the rates to curb COVID, right? Because it was 0% interest rates. So right now, 2025, is anyone's boss game, and the fact that the market is at all-time high with companies performing, and now tariffs that is thrown into the fray, right? So this is where people are feeling uncertain, right? Is he going to say with that probability of the rate cut 85% now? Is he going to say yes, we are going to cut the rates? But if he does that, right, he risks inflation going higher, because as you can see, the PPI is actually quite high, right? But if you don't do rate cut, right, it's going to shock the market. So you can see how they are basically walking a very, very tightrope now. That is why people are really just waiting and see what is he going to say. Okay, so depending on what he say, right, you see how the stock market actually reacts on it. So this is actually what is happening, right? Today, actually in this is in GMT +8, UTC +8, by the way. So you can see that they are going to speak Wednesday. There's nothing, but 2 a.m., which is in the US is at 2 p.m. There'll be these meeting minutes. I think there'll probably be some chats on it, but nothing much. And this is the one that everyone's looking forward to. Right. Okay. Friday, not Thursday. Friday at 10 p.m. So in US is Friday at 10 a.m. So this is where all eyes will be on here. Okay. So this is the 2-day event. So this Saturday one is basically saying it's day 2. But this is where Fed Chair Powell will speak, and this is where everyone will be looking at it. I do think that the unemployment claims coming out will also kind of give some. It's a weekly data that comes out. It will give some idea of how unemployment is too. Now, we summarize all that, right? Everything is to share with you to understand the macro, kind of like the short term thing, because when we know this short term, what is the market expecting, right? We will be able to kind of position our portfolio. That means, like, if you know that, hey, people are feeling uncertain, you don't want to go crazy and go invest all your money inside right now, right? You want to kind of like take a more controlled and balanced measure. So this is the whole reason why we understand the short term. But in the long term, right, I like to share this chart with you, is that stocks tend to go higher even with bad news. And this is a chart dating all the way back to the 1900s with major geopolitical events, right? So markets are always forward looking, right? So yesterday's closing was actually a prediction ahead of what Powell was going to say. So definitely in the short term, there's volatility risk, right? But in the long term, I'm talking like long term, right? 5 years down the road, right? The core thing that still matters is the earnings and fundamentals of the company, right? So you can see that through all these crises, right, we are still in always an uptrend, right? Because it's always being backed by very strong companies' earnings and fundamentals. So at the end of the day, use this macro to help you understand more about the market, about how to position your portfolio, doing portfolio sizing, knowing when to kind of like risk up or risk down. At the same time, right, at the end of the day, to kind of really protect yourself is where you invest in very, very high quality companies for the long run, right? So there's always two sides that we look at as investors, the long term and the short term. Okay, both sides are equally important. So you don't want to kind of like only be long term and neglect the short term. The same for the other way, vice versa. Now, that's all for today's video. Now, if you haven't already, I would also really appreciate if you pause the video right here and follow me on my socials. So just scan the QR code over here for Facebook and YouTube, and it means a lot to me, right? And it will help me to keep bringing you more content and more updates. So thanks so much for the support, and I'll see you in the next video.